Hey everyone, welcome back to the channel. Today we're talking about a topic that excites many newcomers to the world of finance, investing. But starting can feel daunting, especially with limited funds. What if I told you that you could begin your investment journey with just $100? Yes, you heard that right. In this video, we'll break down the steps to confidently invest your first $100, even if you're a complete beginner. Remember, investing carries inherent risk, and past performance doesn't guarantee future results. Always do your own research and consider your personal financial situation before making any investment decisions. This video is not financial advice, but rather a guide to get you started on your investment journey. For professional advice, talk to a licensed financial advisor. First, you'll need to define your goals. Think about what you want to achieve with this $100 investment. Is it a short-term goal, like a weekend getaway that would be in 3 to 6 months? Or a long-term one, like retirement, over 10 years? Understanding your timeline will help you choose the right investment vehicle. For short-term goals, it is not advisable to put the money in the market due to the volatility that exists. This means that the market goes up and down in the short term. Putting the $100 in the market risks that the value might be lower than the initial $100 when you need the money. And you don't want to lose money. You don't want to have less money than where you started. Instead, you should look at safe places to park your money. There are many high-yield savings accounts. SoFi, Ally are two options. Or even certificates of deposit, or CDs, for the time frame that you need. Ally has some good options. American Express also has both savings accounts and CDs. Always ensure that the bank that you use is FDIC insured. If your goals are long-term, investing in the market can be a better strategy. The market has historically had positive returns in the long run. For example, the S&P 500. Longer timeframes help to weather the ups and downs in the market, changes in the economy, and interest rate changes. However, it is important to note that this is for the stock market holistically, meaning this is not necessarily true for an individual stock. This is a stock in one specific company. When investing in one specific stock, a lot more work should be done. This requires reading the financial statements and understanding the market segment. We'll go into some more detail later in the video. Regardless, do thorough research before proceeding. Now back to the $100 that you have ready to invest. Let's say you know you want to invest it in the stock market. The next question is where? Let's talk about some of the investment platforms. Many online platforms offer fractional shares, allowing you to invest in small amounts. This means that you can buy part of shares. This means that you can use the $100 to buy into one security, or you can split it up into different securities. Be sure to check that the platform that you select has the option for fractional shares. Other things to consider are the fees, account minimums, and ease of use. There are many YouTube videos that review the different platforms, and there are many articles that review them as well. I have a video from 2021 that I'll link below. Popular options include Robinhood, M1 Finance, and Acorns. These tend to be more user-friendly, and the apps are easier to navigate. Other options are Fidelity, Charles Schwab, and Merrill Lynch. After you've selected the investment platform, let's talk about the investment options. This is the fun part. For beginners, consider low-risk options. The first type of account to review are ETFs. Imagine you want to buy a bunch of ingredients to make a pizza, but instead of buying each topping separately, you get a pre-made pizza toppings mix that includes everything you need in the right proportions. That's kind of what an ETF or exchange traded fund is for investing. Here's the breakdown. ETFs are a basket of investments like stocks, bonds, or even other ETFs. They are all bundled together into one single security. One single security means one ticker symbol. You can buy and sell an ETF just like you would other stock on the stock exchange. It's like buying a tiny piece of each investment in the basket. ETFs are good for beginners because, number one, they offer diversification. With one ETF, you can instantly own a bunch of different investments, spreading your risk and not putting all of your eggs in one basket. Very popular ETFs are those that track the S&P 500. For example, SPY, VOO, or IVV. Number 2, low cost. Many ETFs have low fees, making them affordable even for small investments. When you are making the selection, look at the expense ratio. This will let you know how much they would charge. The lower the number, the lower the cost. Number 3, transparency. You can easily see what's inside the ETF, so you know exactly what you're buying. This information will be made available on the platform you are using. You can see what is in the basket and how much. You can also see the countries, the market sectors, and a whole host of other information. Number 4 is variety. There are ETFs for almost everything. For specific countries to certain industries, even different types of bonds. Think of it like this. When you buy an individual stock, it's like you're buying a single slice of pepperoni. In ETF, you're buying the whole pizza with pepperoni, sausage, and peppers. Things to remember. ETFs still have risk, just like any investment. Do your research before buying the ETF, understand its content, and how it tracks the market. ETFs are a great way to start investing, but don't forget to consider your individual goals and risk tolerance. Imagine you are filling a suitcase for a trip. Instead of throwing in random clothes, you pack a pre-made beach vacation suitcase with everything you need. That's the idea behind the ETF. The next type of security are mutual funds. While both mutual funds and ETFs offer pooled investment opportunities, they have some key differences that can influence your choice. The first thing to note is structure. Mutual funds are open-ended, meaning they are continuously creating new shares based on the investor demand. ETFs are closed-ended, with a fixed number of shares traded on exchanges like stock. Trading. Mutual funds are bought and sold at the end of each trading day at the net asset value, which reflects the underlying investment's value. ETFs are traded throughout the day on exchanges, with prices fluctuating based on the supply and demand. This is similar to any other stock. The management is also different. Mutual funds actively managed by fund managers who select and oversee the investment. These often come with higher fees. ETFs are usually passive and track an index or a specific strategy. These come with lower fees because they are usually not actively managed. Tax implications are also different. Mutual funds distribute capital gains to investors, potentially triggering taxes even if they haven't sold their shares. ETFs are less prone to capital gains distributions unless they actively trade their holdings, choosing between them. Mutual funds are good for those seeking professional management and potentially higher returns. Importantly, though, fees and tax implications should be considered. Also note that historically actively managed funds have not outperformed the market. ETFs are ideal for cost-conscious investors seeking transparency, flexibility, and lower costs, but may offer less potential for active returns. Ultimately, the best choice depends on your individual goals, risk tolerance, and investment preferences. Do your research and consult a financial advisor for personalized recommendations. Last are fractional shares of stocks, are a way for you to own a tiny piece of a company. even if you can't afford the full share. Here's the breakdown. Fractional shares represent a portion of a single share of a company stock, allowing you to invest in smaller amounts of money. Unlike traditional shares, which must be purchased whole, fractional shares can be bought in any amount, even as little as a few cents, depending on the platform. For example, if a share of company A is selling at $200 and you have $50, you can buy a part of a share and it covers a quarter of the stock. Fractional shares are popular because of the accessibility they offer. They make it possible to invest in expensive companies whose full shares might be out of reach. They also allow you to diversify. You can invest in multiple companies with smaller amounts, spreading your risk and building a more diverse portfolio. They offer flexibility, meaning you can invest custom amounts based on your budget or investment goals. Remember that fractional shares still involve market risk. The price of the stock can go up or down, affecting your investment. Some brokerages might charge commissions for buying and selling fractional shares, and fractional shares may not be available for all stocks. However, always do your research and understand the risk involved before investing. Consider consulting a financial advisor for personalized advice before adding fractional shares to your portfolio. Now that you have selected the platform you will be using for the investment, you know that you want to buy ETFs, mutual funds, or fractional shares. It's time to invest. Remember, investing is a marathon, not a sprint. Don't expect overnight riches. Focus on long-term goals and learn as you go. Utilize resources. There are many options online, books, or professionals. Congratulations, you've taken the first step towards becoming an investor. Remember, even a small investment can grow over time with patience and knowledge. Keep learning, be responsible, and enjoy the journey. Subscribe for more finance content. Share this video with someone interested in investing. Leave a comment below with your investment questions. Again, this video is for informational purposes only and should not be considered financial advice. Consult with a financial advisor for personalized recommendations. One final comment. Many platforms offer fractional shares of cryptocurrencies, but due to their high volatility, consider them only after you understand other low-risk investments. Thank you for watching until the end, and I'll see you in the next one.